ECB's pivot toward rate hikes feeds fears of new bond crisis. European Central Bank policy makers acquire on a Portuguese hillside on Monday with the sinking feeling that their rush to address the inflation shock they didn't forecast dangers both a recession and echoes of the euro location's sovereign debt crisis. As President Christine Lagarde and colleagues meet inside the lodge of Sintra for their version of the Federal Reserve's Jackson Hole Conference, they face competing tasks: cool the quickest consumer price growth inside the euro's history without turning in an monetary downturn or sparking a 2012-style spike in borrowing charges in Italy, the place's third-largest economic system, and different vulnerable states. Markets are already sounding an alert on what may additionally lie beforehand. Italian authorities' bond yields jumped past 4% this month for the primary time since 2014 as investors took fright at the ECB's plan to elevate interest quotes in July for the first time in a decade. With that hike locked in, and another set to comply with in September, officers are racing to supply on their promise of a device to install if yields do surge. The ECB is an amazing issue, stated Charles Goodhart, a former Bank of England policy maker. They can't normalize very swiftly loading increases in hobby rates up front without dealing with the fragmentation issue. Inflation now sits 4 times above the ECB's 2% target, and Lagarde offered a feel of the latest soul-searching last week, telling European lawmakers that officers misjudged certain factors that had a first-rate effect on inflation. The hesitation to boost fees because the Fed and others did was a be-counted of credibility tied to in-advance guidance that's because come to be outdated, she said. While the ECB is now on the brink of reversing sub-zero fees, the turnaround is being tested by the worst sell-off in years in the bonds of indebted euro area governments. With the financial institutions' large-scale asset purchases finishing Friday, policy makers are seeking to lay out a backstop to help tame yields as their push to normalize economic policy shifts up a gear. The Sintra discussion board, which begins this night, was historically supposed as a laid-back event to allow coverage makers and lecturers to mull the larger photo. Market turmoil has often been lurking nearby, however, most currently for the duration of the COVID-19 disaster. This week's retreat can be the first attended in individual by means of Lagarde because she had become ECB president in late 2019 and could feature discussions on globalization, labor markets and digital currencies. But valuable bankers will face greater pressing questions about how they intend to hold the euro region's integrity at the same time as halting inflation. On Friday, 2 days after their meeting concludes, information is expected to show consumer expenditures inside the 19-member bloc hit a fresh all-time high in June. Economics predict it'll attain 8.5%. For those involved about every other bond disaster, there are motives to hope one may be prevented. Average interest prices on debt are lower than a decade in the past, and the average adulthood of what's owed is longer, with the ECB preserving quite a few the notable bonds, in step with economists at Barclays, Lon, BARC, plc. What economics says: surging inflation is causing relevant banks to tighten coverage more difficult and faster. These rate pressures also are building within the euro vicinity, prompting the European Central Bank to set out a road map for retreating stimulus, beginning in July. Still, there are other sources of pain on the ECB. Officials may even stumble upon growing skepticism the various higher echelons in their career that soaring costs can be contained without severe harm to the economic system. Manufacturing output is already declining for the primary time in 2 years. That poses the danger that they grow to be over-tightening, as their predecessors in 2008 and 2011 are nonetheless accused of doing. Fed Chair Jerome Powell, who'll additionally attend the occasion, gave his maximum explicit acknowledgement yet of the risk of a downturn closing week, pronouncing that final results is possible and that achieving a smooth landing is very tough. For the euro location, the on-the-spot economic dangers are possibly even better than inside the US, given a few lie outside the influence of economic policy.